Welcome to the cutting edge of international tax, where the rules of the game are changing faster than your latest software update. For the modern entrepreneur, the world is your marketplace, and a global presence is not a luxury anymore. It happens nearly by default. And with this opportunity comes complexity, especially when it comes to tax. So in this video, we're tearing down 3 common and sometimes dangerous misconceptions that sometimes do trip up even the most savvy business owners venturing beyond their home borders. So if you're planning to build an international business, this is going to be your tax reality check. The number 1 myth we're gonna bust is the magic number of the 183-day rule. It's not written for you as an entrepreneur. So every conversation about international tax seems to start with the same number, 183 days. The common wisdom goes, well, if I spend less than 183 days in my home country, I won't be a tax resident there, and I will be safe. You're wrong, especially for the actively moving entrepreneur. The true purpose of the 183-day rule, or variations of it, originate from the OECD, an international organization, Model Tax Treaty Convention, which forms the basis for most tax treaties in this world. Its primary function is to help countries allocate the right to tax employment income. It essentially says that if an employee works in a country for less than 183 days in a year, their salary may only be taxable in their home country and not the country where they are physically working, provided certain other conditions are met, but let's not get into the details here. So why it feels you as the founder? You're not just an employee, you are an owner, a director, and you control a big part of your business. So your personal tax residency is determined by a complex hierarchy of rules. The tiebreaker rules. They look beyond your physical presence, and we don't count days here. It looks at your permanent home. Where is your primary dwelling? Do you have an apartment, a house somewhere? Where does your family live? It also looks to the center of your vital interests. So where are your personal and economic ties the closest? Where's your bank account, your social life, your professional life, your licenses for your businesses if you have them, need them. Also, habitual abode. Where do you habitually spend your time, even if it's less than 183 days in a calendar year? Sometimes, nationality is also used as a final tiebreaker if above else all fail. So for an entrepreneur, your economic ties, so where your company's income is generated, where you direct the business from, and where your primary wealth sits, that's often which anchor you to a country, even if you travel extensively. So this is to make sure of that for the personal tax residency, which is only half the battle. Your company's residency and also where the profit of tax is usually determined by the place of effective management. Poetically speaking, if you, the founder, are logging into your server, negotiating deals and making strategic decisions from your nomadic location, that country or your old home country may claim that your company's place of effective management is right there with you. So the takeaway here is, don't obsess over counting days. Focus on establishing a genuine, demonstratable center of life and economic activity somewhere or elsewhere. And remember, many countries like the US do have some stricter or citizenship-based substantial precedence rules. So, number 2, when going global, do not forget your exit taxes. So you've decided to move your life, or more important, your business structure, to a lower tax or at least more favorable tax jurisdiction. Congratulations! You successfully navigated the paperwork and are ready for a fresh start. Then, your former home country hits you with an exit tax. Happens more than you think. Exit taxes are levied by a country when an individual or entity ceases to be a tax resident there. They are, the exit taxes that is, designed to prevent residents from simply hopping to a different country to avoid paying capital gains tax on accumulated wealth. So how exit taxes sometimes can catch you off guard. For you as an individual, if you're a high net worth individual, your home country may deem that you have sold all your assets, so your shares, real estate, complex financial instruments, on the day that you leave the country. They then may levy a capital gains tax on the unrealized gains, so the difference between what you paid for the assets and what the current market value of those assets are. You may have to pay a massive tax bill without actually having sold anything at all. For business restructurings, especially with software, this is where it gets truly complex and sometimes painful for tax and service companies. So let's say you're a successful software company and you're headquartered in country A. You restructure to shift the intellectual property, so the code, the patents, the brands, to a new company in country B, like in Ireland, Switzerland, or the Netherlands. Country A will often argue you are shifting a valuable asset, the IP, out of our jurisdiction. They will demand a tax payment on the value of that IP, treating the transfer as an external sale at fair market value. This is known as a transfer of exit or migration exit tax. And this often requires a costly professional valuation of your IP, and the tax authorities need to agree with this. So exit taxes are often a non-negotiable part of any cross-border move or major restructuring, so always get professional help and always calculate the potential tax liability before you sign anything or execute the move. Sometimes the exit tax alone makes the move financially unviable. Third tax myth we're busting here is substance, as it's the real deal and an office is definitely not enough. So it sounds tempting, incorporating in Hong Kong or setting up a branch in Dubai or establishing a holding company in the BVI. Low tax, simple structure, and a sleek corporate address. But global tax authorities are no longer fooled by a brass plaque and a mailbox in a very nice office. Today, substance is the new king. There's a global crackdown on shell companies. Tax authorities have simple questions for any low tax entity. If all the profits land there, what are you actually doing there to earn them over there? So say you have a Hong Kong company. You, the founder, are negotiating all the contracts from London. Your developers are in Poland. Your sales team is in the US. And then you have a Dubai free zone entity, but you are never there. And the one employee is a local nominee director with no real authority. This is the classic definition of a shell company or a letterbox company, which is basically an entity lacking any economic substance. What do tax authorities really look at? So the substance checklist, if you were. To genuinely defend that your profits belong in country X, BVI, Hong Kong, Dubai, you need to demonstrate the following. You need to demonstrate there's genuine management, so the key strategic decisions, hiring, budgeting, investment are actually made in country X, and the majority of the board management lives in that country. You have adequate personnel, so do you have full-time qualified staff working there? You need people with the competence to execute the business functions that generates the profits. So do you have the papers, the education? Do you have a physical office? So do you have a dedicated operational office? Not a shared desk rental that you visit once a year. Do you have local activities? So are the core income generating activities, so the development, the sales, administration, treasury management, genuinely executed and controlled from that country? That's the question they're going to ask for sure. So if your Hong Kong or Dubai company has no real employees, only nominee employees, no local management, and all strategic directions come from your laptop in Portugal, your home country, or in Portugal maybe, or wherever the value is created, will most likely use controlled foreign company rules, permanent establishment rules, or other anti-abuse rules to reattribute the profits to the country where they are created, and that's in the higher tax jurisdiction with probably some penalties. So a low tax jurisdiction will only work if you're willingly planting genuine roots there. So management, people, and genuine real economic activity. So your tax planning must follow your business reality and not the other way around. So my final thought is that the time for tax amateurism is over. The days of relying on simplistic rules or using letterbox companies are long gone. Global tax authorities are also communicating more than ever, and the penalties for non-compliance are increasing moreover. So, if you are building an international business, it demands a legally sound and substantive tax strategy. Your success hinges not on finding a loophole, but building genuine structures that accurately reflect your global operations. So make sure that you consult qualified international tax advisors like myself or my colleagues before you book the plane ticket or you sign your next restructuring. Your future global enterprise depends on it.